According to a Harris poll, 64% of Americans will welcome a recession if it meant lower interest rates because, well, home buying has become so freaking unaffordable that, in fact, 3 in 5, or 61% of Americans who have never purchased a home, have basically given up all hopes that they will be ever able to afford one. And, well, this is even a more disproportionately number that's impacting younger Americans. So obviously with this current housing crisis, I wanted to create this video and basically talk to you guys about some really cool ways to still make home affordability be possible in 2024. Obviously, after 2023 was pretty much the least affordable year in home buying, in which basically people had to spend over 27% of their take-home income to be able to afford mortgage payments. So let's go ahead and go over some of these examples. Some of them are not going to apply to obviously just you personally, but I want to go ahead and cover multiple options and multiple situations in which you might find yourself if you are buying a home right now in 2024. And with President's Day just a couple of days ago, this is basically the start of the home buying season, the unofficial start. So let's go ahead and get started. So for some of you guys who are, who are looking for a way to afford a home, I'm going to go into something that honestly has been around for a very long time. Okay. And that is to basically just buy a home that is in an up and coming neighborhood. Because in many cities, still to this day, there are still a lot of areas that are kind of going, revitalization projects and all of these things. And obviously, they're not areas that are already established. So this is going to help you, some of you guys who are young professionals and maybe, with your families, to be able to get into a home in these neighborhoods that can often kind of give you a little bit of a lower price on their homes and maybe even get on the ground floor if that city is going through some sort of, revitalization project. So this is a really good way for some of you guys who are first-time home buyers to really get into the market. I feel like I have to say this because nowadays it just seems like a lot of people are going for new construction home, and also first-time home buyers are going for new construction home, which, hey, by the way, it's no problem. I definitely understand 100%. But when you buy a new construction home, it's always going to be a lot more expensive than an existing home. As a matter of fact, in 2023, the average price of a new construction home was roughly about $434,700. Obviously, an existing home averages roughly at $387,600. That was in 2023, so it's roughly about 12% less. I know that some of these numbers are not going to apply to some of the high cost living areas, like, maybe you live in the West, maybe you live in the Northeast. But honestly, the concept is still the same because it's still, if you're looking for an affordable buying option, you want to consider buying something that's already existing and not a new construction where the builder is, obviously, they're trying to make a profit. They're going to charge more for giving you a new construction home. So if you're a first-time home buyer and you're trying to keep your expenses as low as possible, don't go for a new construction home. Go for an existing one, all right? Now, one really cool strategy that you can take advantage of when buying an existing home that might need some repairs and might need some updates is that you can actually purchase them with a rehab loan or one of those, FHA 203K loans as an example. For instance, these loans allow you to finance the property and also finance the repairs that you need to do, whatever improvements into the new mortgage. So, or what the heck, maybe you don't want to deal with the headaches and the potential delays of getting a rehab loan, when you're actually buying the property, and that's totally okay. You can still, purchase a home, move into it and then do a few things yourself, wait out 6 to 7 months until you're eligible to do a refinance. And then you can do a rehab loan like that 203K that I mentioned. Or there's another option called the Fannie Mae Homestyle Loan. That's the other extremely popular rehab loan, which is a conventional mortgage. Either way, you're going to be able to use these loans to help you buy more home for your money. Okay. So honestly, it's it's something that I think it's very underutilized by people. Obviously, a lot of people are scared to do projects or to do a lot of stuff around the house, and I definitely understand. But check this out. According to a report by the National Association of Realtors, purchasing a fixer-upper and using a renovation loan can save home buyers an average of 8% on the purchase price compared to buying a move-in already home. Now, obviously, again, this option is going to require you doing some work or hiring people, obviously, to do the work. But it's going to help you save a lot of money in the future. And I'm going to give you a hypothetical example, but it's actually something that is pretty real. All right. So say, for example, that you buy a fixer-upper or an outdated home for $400,000, but comes in the area or of similar homes are around 500,000, for homes that are in good condition. Okay. So you're probably going to need about 50,000 to get the home up to par. Now you can use the renovation loans to finance the repairs and updates that you're going to need to get you into the home in line with those comps. So once you complete everything, you're going to have a home that's worth 500,000, but you only pay 400,000 for it. And you put in $50,000 in repairs that you finance with the loan, which now you're basically now creating $50,000 of equity or 20% of equity in the property. And if this happened, you could then go ahead and refinance the home again in a few months and get rid of the mortgage insurance, because now you're going to have that 20% equity or the 80% loan to value. So see, in this way, you're able to create equity in the property. Whereas if you buy a new construction home, and again, I'm not trying to bash buying a new construction home, but the potential of equity that you're going to have in this property in the new construction is going to be very, very small, because everything is going to be priced in already. Hopefully that makes sense. Anyways, I want to move on to a second example, and that's basically by house hacking. Okay, so house hacking, extremely popular nowadays. You see it all over the internet, TikTok, whatever, Instagram, of videos of people talking about house hacking, and that's totally cool. But it's still, in my opinion, very underutilized. I'm going to give you an example, and this is basically by purchasing a multifamily property. Now, this option allows you to obviously live in one of the units and rent out the other units for additional income. This is going to help you offset your mortgage payments, and it's going to help, your homeownership journey more affordable, especially if you're a first-time home buyer, or especially if you're able to, be okay by living in one unit. With multifamily homes, the units are typically smaller, so you have to kind of be okay with that. If you have a large family, it's a little bit inconvenient. But if you are a single person, or maybe you have a significant other, you guys are okay with the enough room in a multifamily, just live in one of the units and rent out the other one. So when you buy a multifamily home and you plan on living in one of the units, at least, what I suggest for people to do in the first year, because, you want to live in it for at least 1 year, is just take advantage of the FHA loan and put the minimum down payment of just 3.5%. So very simple. It's been around for a long time. Or you could do a conventional mortgage that's going to be 5% down. So, imagine you can just buy a duplex that, for example, it's going to cost you $550,000 for it. Your total monthly payment out the door will be somewhere around $4,000 a month. But you should be able to comfortably rent the other unit for, I don't know, $1,700, $2,000 a month. And obviously now that tenant is helping you pay for the property, and you're increasing also your level of equity as well, especially if you repay into the mortgage. After 1 year is up, you can do whatever. You can stay in the property, or, my personal best would be to look into renting out the whole thing, leave the property, and then go and buy another primary home, which is going to be maybe a bigger property. Okay. So, you guys can do that every year. If you say that you're going to live in a property, you're going to use it as an owner occupied home, you want to stay in it for at least a year, right? Because you're actually signing legal documentation saying that you're going to live in the home for a year. Okay. Now, obviously, again, I know this example is not going to apply to everybody, because, maybe you have a family and just living in a duplex is not is not very convenient. But you don't need to do a multifamily. You can do a big single family home with a basement, right? Basement with an in-law suite. Even if you're able to just rent out a portion of your home and reduce your overall expense by maybe $800 to $1,200 a month. I know, like in my area, a nice basement rents out for $1,200 to $1,500, all utilities included. That's still a pretty good amount of money coming in. That's roughly $20,000 coming into your to your pocket every year, right? That you can use to either pay down the mortgage, put it in savings, whatever it is. Okay. All right. So let's go ahead and kind of move on from these two examples, because again, I know these are going to be a little bit more geared towards those who are first-time home buyers, or maybe those people who have a lot of flexibility. So let's talk a little bit more about some financing examples to help you save some money. And these are going to apply to you whether you are buying a home for the first time or you're not. So the first one is, you want to negotiate for the seller to pay your closing costs instead of reducing the cost of the property. Now, I know what you're going to say in hindsight, why would I do that? But here's basically the deal. A lower purchase price doesn't necessarily mean a lower monthly payment when you're getting a mortgage. I mean, it does reduce your monthly payment when you're paying less, but it's not by a whole lot, not by as much as you think. So instead, seller pay closing costs translate to out-of-pocket savings for you at closing. This is gonna make a bigger difference when you're buying a home, especially if you have a tight budget. So, for example, if you were to buy a $600,000 home, your closing costs, depending on the area where you are, this could be anywhere between 2 to 3%. Let's just kind of go in the middle and say that your closing costs are about 2.5%, right? So in a $600,000 home, this is $15,000 in closing costs. If you were negotiating with a seller, you could ask them to pay the full amount and saving you $15,000 up front. So in essence, you are buying the home for $485,000, but you're financing the closing costs into the loan. This makes more sense than just reducing the purchase price to $585,000 without any seller pay closing costs, because let's say that you ask for a $15,000 price reduction on the property. That will just only reduce your monthly payment by roughly $85 a month if you maybe assume a 6% mortgage over 30 years. But if you were to go with the seller pay closing cost option, and keep the $600,000 purchase price, right? At least in my example, your loan amount is going to cover all of these costs, but the monthly payment is only going to be $85 more expensive, right? Compared to buying a house for $585,000 with no closing costs. So my question to you is, do you want to save $85 a month or $15,000 upfront? To me, I would want to save $15,000 upfront. I can go ahead and take on the little bit of a higher monthly payment by $100. Who cares, right? Even if you were to keep the loan for 3 years, you're only saving $3,000, right? For just having a lower price and obviously a lower monthly payment. So if you're financing a home, it almost always makes sense for you to get the seller to pay your closing costs, okay? If you're able to. I know that this basically is a little different depending on the market where you are, but I'm willing to say that in almost every market across the country, and that goes for, really hot markets, whether you're down in Florida or somewhere in the South where it's, very popular, Texas maybe, or maybe even out West, or even in the Northeast. But I can assure you that right now the market has slowed down for basically everybody. So you may be able to get your closing costs to be paid by the seller, or at least a portion of it, at least now that the interest rates are kind of high and the market is a little bit soft, okay? So you're going to get a lot more sellers willing to do this. If you wait until the rates go down, and then obviously that introduces a bunch of new buyers into the market and obviously more competition, then it's going to get a lot more difficult for you to be able to negotiate seller pay closing costs, all right? And I'll tell you, like, this is a piece of news from last year. So at the end of last year, sellers were slashing prices and yielding to buyers with concessions to close deals. Almost 21% of the homes sold in October had a price cut of roughly about 35%. 35% of sellers were offering concessions like cash for mortgage rate buy downs, repairs, or closing costs. So this was as of last year, and last year the market was a little soft, and it's sort of the same way now, especially with rates going back up again of the highest in the last couple of months. Okay, so this is really going to take me into almost my final point, and or almost one of my final options, and that's going to be of making home buying a little bit more affordable, and that is by doing a buy down program. So buy down programs have been around for decades. Okay, this is nothing new. Everybody forgets about them, when the rates are very low, but they remember about them when the rates are extremely high, or multi-decade highs like what we have right now. So basically what a buy down program is that the seller agrees to pay a certain percentage of your mortgage interest rate for a specific period of time. This can significantly lower your monthly mortgage payments, and it's going to make your home ownership a little bit more affordable, at least for the first either 1 year, 2 years, or 3 years of you buying the home. Okay, so I'll give you an example. Let's say that you're getting a mortgage for $450,000 with an interest rate of 7%, which roughly speaking, this is what it is right now. The seller agrees to pay 2% of your interest rate for the first year, so it reduces your rate to 5% in the first year. Okay, it saves you approximately $578 a month. Because at 7%, which is the real interest rate that you will qualify for right now, you're going to have a payment of roughly $3,000. Again, that's on that purchase price. But at 5%, it will be about $2,415. So that's going to be at least for the first year. Then on the second year, the rate is 6%. So you save almost $300 a month, and then it defaults again to 7%. After the 2 years are up, hopefully then the interest rates are going to be lower, and you can take advantage of refinancing, and obviously thereby reducing the actual rate again. This is what we call a 2-1 buy down program. Okay. Now there are multiple buy down programs, but this one is the most popular one. But the other one that is available is the 1-0 buy down, which allows you to get a lower interest rate on the first year only, and then it defaults into the actual rate of the market of today. And then the other one is the 3-2-1 buy down. So in the first year, your rate is reduced by 3 percentage points. So if you start at 7%, your first year interest rate will be 4%. Then on the second year, it will be 6%. And then on the final year, it'll be 5. Okay. And then it defaults again to 7. Again, these are, some unique circumstances, whatever I thought I mentioned to you. But I think to kind of like finalize this and to help you guys make your home ownership thing a little bit more affordable. Again, this won't probably, this one apply to everybody. But if you're a first-time home buyer, you're definitely going to want to find out about some sort of grant or some community assistance that may be available for you. And I'm going to be a little bit biased, but this is kind of where you may want to work with a mortgage broker instead of going with a regular lender or one of the big banks. Now, I don't necessarily know every available grant in the country because quite frankly, there are a lot of stuff going on. But, here in my company, we're mortgage brokers in Georgia and Florida. In Atlanta, which is where I live, there's a pretty cool grant that awards certain first-time home buyers who live in different parts of the city with up to $5,200 for their down payment, their closing costs, etc. I know that same grant is available in cities like Detroit, Chicago, Baltimore. In Florida, there's a couple of things as well, depending on the area where you are. So you may want to do your research, ask a really good mortgage broker to see what kind of things they might have available. But I definitely look into grants. Okay, grants are a part of down payment, are kind of a way of down payment. But there's this other subset called down payment assistance. Now, down payment assistance is not something that I necessarily love because it's not free money. Okay, they're actually loans that you do have to repay. Their second mortgages, so you do have to make a monthly payment to them. They might be forgiven. They might not be forgivable. Most down payment assistance programs are not forgivable, so you have to pay them back. But listen, if it's a means to an end, right, to get you into a home, maybe you are really well qualified, but you are lacking the down payment. Maybe you can save it over time. You just can't save it now. Then definitely look into down payment assistance, okay? Because then you can go ahead and like pay it off in the future or whatever, okay? But down payment assistance can give you roughly up to 5% of the purchase price, so it can give you a lot of money. We've had a lot of clients, especially towards the tail end of last year when rates got crazy. And people really kind of were struggling a little bit to save. We did several down payment assistance programs, which allowed our clients to get into a really nice home, and they're gonna be paying on those loans over time, and that's totally cool. You know, when the rates go down, they'll be able to refinance and hopefully even just roll the down payment assistance and the first mortgage into just one loan. So that's something that could be doable if you do down payment assistance. Okay. All right, guys. This is basically all I have for now. You know, I know that things are pretty rough right now. Rates just basically, you know, went up again. We're like roughly a 2.5 month highs basically. So rates are kind of crossing a 7% range again. So I know things are not easy, but hopefully in this video, I know it's a little bit long, I'm going to go ahead and cut it up, you know, put the little chapters on the description box below. And then hopefully this helps you out. If you guys found it helpful, just, you know, give it a like, helps the channel, subscribe if you like as well. And I will see you guys on the next video. I appreciate you watching. Thank you again. Have a good one.